So, imagine this. Institutional investors went on a shopping spree during the pandemic, snapping up over 300,000 homes like they were collectible Pokemon cards. They didn't just pay the asking price. Oh no, they often shelled out way more. Fast forward to today, and those aggressive acquisitions have turned into financial black holes, with property values taking a nosedive like a swan doing belly flops at the county fair. Now, hold on to your wallets. The average value of homes bought by these investors has plummeted from a jaw-dropping $420,000 to a mere $365,000. Yes, you heard right. That's a staggering average loss of $55,000 per property. Talk about a reality check. It's like buying a luxury car and later finding out it's worth less than your neighbor's slightly used bicycle. And if you thought that was bad, brace yourself for this. The total immediate equity losses for these institutional investors now stand at a whopping $16.5 billion. That's billion with a B. And let's not forget the pesky ongoing costs like taxes, insurance, and maintenance that are lurking around like unpaid bills from an overzealous ex. Those could really pile on the financial stress. Who knew homeownership could feel like an episode of a bad reality show? In the wild world of real estate, leverage is like a double espresso shot. Exciting, but if you overdo it, you might just crash hard. When asset values start to drop, margin compression events can turn investors' dreams into nightmares, especially if they're heavily leveraged. That's like being on a seesaw with a kid who weighs twice as much. Good luck regaining your balance when things go haywire. Speaking of heavyweights, let's chat about the major players like CalPERS and the Texas Teacher Retirement System. These pension funds did a cannonball into the market at its peak, and now we're all wondering if they're going to float or sink. They've invested billions, and with retirement assets hanging in the balance, it's like watching a high-stakes game of financial chicken. Who'll blink first? Regions where these institutional investors threw their money around during the pandemic are now reeling from the aftermath, like a party that got out of control. States like Florida and Texas are right at the epicenter of this housing value earthquake. It's as if the housing market decided to take a permanent vacation and not a fun one. In Tampa Bay, those institutional investors are feeling the heat, losing $360 million in equity from their properties, which are valued lower than a clearance sale at a thrift store. The impact? Oh, it's catastrophic for the local market. It's like watching a bad rom-com where all the characters end up heartbroken, and the plot twist is just more heartbreak. Over in Miami-Dade, things are even messier, with institutional investors suffering a whopping $660 million in losses. Talk about concentrated risk. This is like a game of financial Jenga, and one wrong move could send the whole thing crashing down. Investors on the edge of their seats may want to reevaluate their life choices. As for Austin, Texas, investors are looking at staggering losses of $617 million. Yup, you heard that right. This reflects a broader trend of overvaluation, making it tough for investors to stick to their financial game plans. It's like trying to juggle flaming torches while riding a unicycle on a roller coaster. Dangerously complicated. To add to the drama, rating agencies are downgrading real estate investment trusts faster than a bad movie gets pulled from theaters. That means borrowing costs are climbing higher, putting even more pressure on profit margins. It's like trying to outrun a bear with a sprained ankle. Good luck with that. Meanwhile, in markets like New York, where institutional buying has been as scarce as a unicorn, home values are actually on the upswing. It's a wild contrast to regions like Texas and Tennessee, which are drowning in an inventory surge that's way above long-term averages. It's like watching two different movies. One is a feel-good rom-com, and the other is a horror flick. The complexity of financial instruments, like mortgage-backed securities and real estate investment trusts, has dramatically increased institutional exposure to the housing market. If that sentence sounded convoluted, it's only going to get better. Picture it as a tangled ball of yarn that a cat got into. Good luck untangling that mess. Now, the National Association of Realtors is feeling optimistic about a market rebound in 2026. Yep. Despite their previous oopsies when predicting downturns, they've got their eye on the prize. But let's not kid ourselves. It's like predicting the weather based on last week's forecast. What could possibly go wrong? Strategic portfolio adjustments from big-name investors, like selling off properties in declining markets, will be eye-catching in this chaotic landscape. It's pretty clear that they've finally realized we're not in Kansas anymore, and addressing current market challenges is a must. It's a wake-up call that we all saw coming, but hey, better late than never, right? Experts say that the optimal buying window is lined up for spring 2026, thanks to a potential influx of inventory and institutional selling pressure. Timing your entry is like trying to perfect your dance moves at a wedding. Get in there at the right moment, and you'll own the dance floor. Certain markets are really feeling the heat with concentrated institutional selling, particularly in sunny Florida, hip Austin, lively Phoenix, and vibrant Charlotte. If you can identify these areas, you might just find yourself in the sweet spot for advantageous buying conditions. It's all about knowing when the stars align for that perfect deal. And let's not forget, these institutional sellers are more motivated by minimizing losses than cashing in on profits. It's a total game changer for negotiation dynamics. So, for savvy buyers, this shift could be the golden ticket to snagging a bargain. Just remember to bring your A game and maybe a pair of negotiation shoes that scream, I mean business. All in all, folks, the housing market might be a roller coaster ride right now, but for the savvy and strategic investor, there's still a silver lining waiting to be uncovered. So buckle up and get ready for the thrill. This market is sure to keep you on your toes.